Thank you for taking the time to hear about an exciting wealth protection and planning tool FUTR Family Management offers the families it works with. The focus of this presentation encompasses 6 slides over a few short minutes. This presentation is not meant to make you an expert on captive insurance companies, but rather our goal is to provide you with enough information to decide whether or not you should meet with FUTR Family Management to answer questions which are specific to your situation. This short presentation will review what is a captive insurance company. We will also review false rumors and what captives are not. In addition, we'll talk about common risks that captive insurance companies cover, the benefits of captives. We'll talk a little bit about operational features of a captive insurance company, and then finally we'll talk about what next steps you should take. While a captive insurance company may offer substantial wealth building and wealth transfer benefits, captives are first and foremost a risk management tool. Most families and businesses have certain risks which are self-insured, whether they realize it or not. Prudent families and businesses set aside funds in order to cover losses incurred in the future. Generally, this means that you earn money, pay taxes on that income, and then set aside the leftover cash for potential losses in the future. A captive allows businesses and high net worth families to set aside pre-tax dollars in order to provide cover for possible losses in the future. Many advisors over the years have tried to take a good thing and make it too good to be true. They push deep into the gray area in order to set themselves apart and separate others from their money. Or the promoter simply sells the sizzle and forgets to be diligent about dotting the I's and crossing the T's. Essentially, the promoter is just that, a promoter as opposed to a true advisor. So, as with many things, a good program gets a bad reputation and the government steps in to protect the people. Such has been the case in the past with captives. There were promoters who sold the heck out of the benefits without actually sticking to the basic fact that captives are at their core a real insurance company. Having spent decades in the life insurance world, we've seen several schemes which attempt to give you all the benefits of life insurance, but allow you to cut out the IRS. A few years back, there were firms trying to market captive insurance companies as a way to purchase large life insurance policies on a tax-deductible basis. This generated huge commissions, but appears to be an abuse of the statutes. We do not recommend captives as a way to purchase life insurance on a tax-deductible basis. The good news about these issues is that there is now a substantial case law which may provide us safe harbor as we look at captive insurance companies in the planning for our high net worth families and business owners. As an example, the Harper Group versus Commissioner case gave us 3 hurdles or requirements which we must clear in order to have a valid insurance arrangement. First, does the arrangement involve the existence of an insurance risk? 2, there needs to be both risk shifting and risk distribution. And then finally, third, is the arrangement for insurance in its commonly accepted sense? Keep in mind that a captive must offer valid insurance coverage. The example I use is that a captive could not offer hurricane insurance to a company in Kansas. There must be a legitimate risk. The other thing to keep in mind is that for the most part, your captive should not be offering the same types of coverage you can get from traditional commercial insurance companies. Having said that, this page lists some of the more common risks insured by Section 831B captives, or what we call small company captives. This is an important list because captives need to diversify their risk if they wish to operate their businesses prudently. And the more risks families or businesses shift away, the more wealth they will end up being able to transfer. You may wish to pause this recording here in order to fully review this list and determine if you have any exposure to these risks. Often, clients did not even know they had these risks and they were unwittingly self-insuring against these potential losses. Now, if you paused on the last slide, welcome back. For those of you who have pressed forward, we should be able to get through the next 2 slides fairly quickly. Up to this point, we have focused on the risk management aspects of captive insurance companies. Certainly, Risk management is the core value to wealth managers such as ourselves. But there are other ancillary benefits for our clients, benefits which may actually increase a family's wealth over generations. While I've broken out the first 3 bullet points on this slide, they actually are very closely related and go hand in hand with each other. Clients often find they have risks which they can't find a policy for or that they are too expensive, so they choose to self-insure. Part of that high cost obviously ties to the severity of the risk they are asked to cover. However, think of the overhead and sales costs associated with most insurance companies. A captive does not have all that fixed overhead and cost of sales built in. So, in the end, your captive is able to offer you a policy at a rate which might be more reasonable. Another benefit of the captive is that any profits inure to the benefit of the captive's owner. As a result, the less your captive pays out in claims, the more wealth retained by your captive. So we find that in addition to the claims adjusters, many owners keep claims to a minimum on their own. One of the examples I've used in the past is when a person has a fender bender and they need to decide whether it is worth it or not to file the claim with their auto insurer. Another interesting benefit of creating a captive is that its assets are not generally accessible by the claimants of you or your operating company. Captives are a separate legal entity and not generally involved in your litigation or creditor claims. Our focus is typically on small company captives. Section 831B allows a captive to collect up to $1.2 million in premiums each year without having to pay income taxes. In addition, many states have or are rewriting their statutes in order to attract these businesses to their state. This allows us to help you find the best state of domicile for your particular needs. In addition, at this point, dividends paid out to a captive would be taxed at a lower rate than ordinary income. Even though you deducted the premiums when you paid them to the captive. Of course, if you borrow from your captive at legitimate rates, there is no taxation if you pay back the loan. Lastly, depending on the ownership of the captive, there should be a step up in basis at death. That brings us to the last point. Captives can serve as a wealth transfer function. When premiums are paid to the captive, they are paid in as premium and not treated as a gift, even if the captive is owned by a trust for the benefit of your heirs. Then, if the ownership is structured correctly, the value of the captive is not included in your estate for estate tax purposes, even if you've paid in more or grown the assets to greater than $10.5 million. And the transfer does not require your death to occur. We've also seen captives used in an executive compensation strategy. So in the end, a captive reduces the cost of potential losses, but can also be a source of wealth building for families and businesses. Most families and their counsel are not experts at creating and running an insurance company. For that reason, FUTR Family Management has partnered with Oxford Risk Management Group. Oxford Risk Management Group is a dedicated team established to provide captive education, feasibility, implementation, and management services on a turnkey basis. Feel free to go to their website and research their capabilities and see why we chose to partner with them. Given the benefits of a captive, we are often asked about who can really use this type of program. We have the ability to set up a captive insurance company for clients with risks that require a minimum premium of $50,000 per year. Of course, given the wealth transfer benefits, some clients may want to know how much they can pay to their insurance company. Given the benefits of small company captives, the max you can pay to any one captive is $1.2 million per year. However, for some clients with more risks, there may be the ability to create multiple captives to cover multiple risks. In those cases, each captive would be limited to $1.2 million per year in premiums. Of course, the question here is, what's it going to cost me? That is, what does it cost to set up and run a captive? Well, the short answer is that it varies based on a number of factors. For instance, the smaller the premium, the higher the cost as a percentage of that premium. But as a general rule of thumb, the cost of your captive should run about 11.1% for smaller premiums and grade down from there as you approach the $1.2 million premium. So, for instance, out of a $100,000 premium, approximately $89,000 of that premium would be going into your captive insurance company. That means the cost is about 1/3 of the normal tax rate. And it is important to keep in mind that this is a rule of thumb. We generally find the cost is less by the time Oxford and FUTR finish up with the underwriting processes. I also want to take a moment to discuss claims. If you remember back to our earlier slide, claims are managed and spread among other captives in a risk pool. So while your captive is responsible for paying claims, you and Oxford will apply proper claims adjusting so that the captive is not on the hook for more than necessary. The second aspect of claims management is that approximately half of the claim will be spread out among the other captives in your risk pool. So for instance, if you have a $100,000 claim, almost $50,000 of that would be spread amongst all the other captives in the pool. So if there were 100 captives in the pool, each of them would be covering $500, and your captive would cover the other $50,000 or so. Another operational point to be made is that when you pay the first premium to your captive, 20% is put into an interest-earning cash account as reserve. No investment risk is taken with this money. The rest of the premium flows to the general account where it will be invested conservatively and in accordance to a customized investment policy statement you and FUTR Family Management establish. As time goes by and claims are minimized, your captive has profit. This profit is what I call the general account, and it will be invested according to the investment policy statement. The goal is to grow the general account assets over time and add to the value of your insurance company. So that brings us to the final point. FUTR Family Management is a family-focused asset management firm providing solutions for wealth, succession, and philanthropic legacies. Family wealth is about more than money, and our job is to facilitate communication among the generations, helping them to clarify and realize their family mission, vision, and core values. Our firm will be responsible for managing the assets within your captive insurance company and ensuring the captive fits into your overall wealth management planning. We desire to be your guide. So, whether you are attracted to the substantial benefits of creating your own captive insurance company, or you remain the skeptic thinking it is too good to be true, we recommend that you contact FUTR Family Management to go into more detail and answer questions specific to your situation. Thanks for your time.